Thank you very much. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Inuit, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. I'd like to introduce the panel members this morning via Zoom: Gail Anderson and Kevin Stephenson, and myself. I'm chairing this meeting. My name is Mike Truglio. Representing the department this morning is Justin Mikulak, and our administrative personnel is Fran Picotto. To the Zoom participants of the hearing, please note you are placed in waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along the City of Winnipeg's Boardroom Vision YouTube channel for the hearing process. Once the host admits you into the hearing, please close or mute your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will hear application for revision of the assessment rule in accordance with the Municipal Assessment Act. The matters for which revision is requested has been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of the market value by the Board of Revision. The Board of Revision is appointed annually by council and is independent of it and the city administration. It makes its decisions on the basis of evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to Court of King's Bench if the matter pertains to application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed, with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to surmise if they wish. Once all evidence about the application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after the applications have been heard, and the board will deliberate in private and make its decisions. You'll receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 1 through 8 today on our docket. And I think we'll wait to swear everyone in once everyone is available for the hearing to commence. And in the meanwhile, we are going to adjourn till 9:30 apparently. So thank you very much for your patience, and we'll be right back. Ms. Picotto, would you please affirm the assessor and the applicant's testimony, please?
Mr. Assessor, please state your full name.
Justin Mikulak.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. Mr. Applicant, please state your full name.
Rocky Neufeld.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you.
All right. Mr. Mikulak, would you please walk us through your presentation?
Okay, so this is file number 24-3634, roll number 010042660000, 6105 Roblin Boulevard, roll year 2025, assessed value 2,552,000, classification 20, liability is taxable. We have one building, 3 stories, built in 1973 with 23 suites. If we scroll to page 2, you could see the location of the property, located in the South Boyne neighborhood down towards the west end of Roblin Boulevard. I guess the overarching neighborhood would kind of be like Charleswood area. So a pretty good location from that regard. We do have a sale on the property from October of 2021 for 2.5 million. And if we scroll further here to the income value summary on page 3, you could see our average monthly rent per unit at $918.90, which works out to the gross potential rent of $253,616 from our model, and then the expense ratio 49.48%. Will get you a net operating income of 123,770 with a 4.85 capitalization rate to come up with the 2,552,000 and a market value per suite of just shy of 111,000 per unit. Page 4, when we look here at just some other rent comparables of properties in the market region, you could see where this property would fall relative to others. So we're at $918.90 per unit, and we have a range here from similar, we got $924 up to $1,128 per unit of properties kind of built in that similar time frame. When we go to page 5 here, looking at our cap rate, so the multifamily section between the 20th to 80th percentile, we've ranged from between 4.75 to 5.45. And you could see where that falls in line with other broker market reports. So we are in a reasonable range here on cap rate as well. When you see further, we provide some cap rate evidence of actual sales to support the model. So on page 6, we have provided sales, which we have stabilized their reported income to the city of Winnipeg, and then putting that into the sale price, you could see the range of cap rates that we get. And so, you know, on the low end, we might get ones that are sub 4, but most of them are above 4 to about 5.25. And so this is really used for us to justify that the model cap rates that it's applying to the value seem reasonable based on the sales that we have. And so this is just again further affirmation on our end that the cap rates we're using are reasonable. If you look at this property on page 8, so shortly after the sale, there was a permit taken out. So in November of 2021, there was a permit taken out for interior and exterior alterations. And if you look on page 11, you could see that the property has now been fully renovated. So when you see the income stream on page 9 and 10 of what they have reported in 2022, you could see that they are collecting rents based on the rehabilitation. That's evident. Page 10, you could see that on their income statement, they do have the value allocation towards the income stream. So really, we're low on the net operating income here, based on the premise that the rents aren't reflective of what they're getting. So I mean, this would definitely be one where we would be looking at inspecting and updating the value based on the newly reported income. So we're asking to maintain the value at 2,552,000. Thank you, and that's my presentation.
Thank you very much. Questions, Mr. Neufeld?
Yes, when was this permit closed?
I don't believe it has been closed on our end.
I'm looking at the city of Winnipeg permits and I have a date here of closing date, November 24th, 2021. Do you dispute that?
It's not on our end. It hasn't been closed. It maybe has been closed on, through property planning and development, but not through the assessment department.
Does the assessment department close permits?
We do, yes.
You don't close permits, do you? You get information from property and planning and then you process the change, but you don't have the official ability to close a permit, do you?
That's how we handle our processes internally.
Right, but that's just a manner of speaking, correct?
Okay.
And did you review the actual statement? And I'm looking at page 10, the top of page 10.
Mhm.
You note that this is for the period following the closing of the permit?
Well, I guess it was in 2021. So that would make sense, yeah. 2022 income, which they have high vacancy with the discounts applied and the income. So I would say that, yeah, that's collecting new rents at the updated value.
Right. So that was my next question. After closing the permit and going back into business, the statements indicating on page 9 significant vacancies. Wouldn't that be typical for an operation that have to suffer vacancies while they try to repopulate?
That's correct.
And in this period of absorption, what would be a reasonable time for allowing absorption, or do you have one?
I would just be looking at, history on the property, going to the website, seeing if they have any vacancies. I don't know, every property can be different. I assume this lease up was probably pretty quick.
Well, you wait. You make a statement. Assume you haven't checked any into it, have you?
I have not, which is
Okay.
why I'm asking for the value to be maintained.
Okay. So, in other words, you would presume guilty and have them prove that they're innocent rather than assume they're having a problem and fix it later.
Sure.
Okay. The cap rates that you brought forward, do you have any idea what the mortgage interest rate was on these properties and whether it was assumed?
I'm looking at information that was reported to the city by these properties and then stabilizing on the sale price. So I would not know.
Okay, that's all I was wondering. And were any of these renovation projects?
No, which is why we don't include those ones if there's been permits pulled out after the sale for that reason.
Now, okay, on your page 5, um, why do your multifamily rates show a lower range than most of the market participants?
I would say that when we get data collected by property owners that submit their income and expense information to us, and we line that up based on sale price, we tend to get cap rates that are probably a little bit lower based on the reporting.
Right,
I don't
okay,
know.
that's a fair answer. And does anybody go back and investigate previous years? For example, when you're getting a property ready for sale, you spend a little bit more on repairs and maintenance to make it look better for sale. Um, do we know if any of that was stabilized or specifically, were any of the vendors and purchasers involved in these transactions contacted and asked about the circumstances surrounding their purchase or sale?
Yeah, so we do send out mailers to owners when there is a sale, for them to, ask, like, get back information about these sales, for us to make a judgment on whether or not we need to include properties for analysis, and that's how we come up with the cap rates.
Right, you send the mailers out, but is there any follow-up with these owners? Like, and let me just get to the point. You've got a range here of 5.74 to 3.46, which is quite extreme.
Yeah.
Does anyone try to figure out why did this happen?
You know what? We look at what they report to the city and we use that data to come up with cap rates. I mean, I think that's just the way we produce assessments is the same way that we're gathering the sales data, which is by the book what you're supposed to do. So um, I don't, that's really all I can comment
Okay.
on.
Oh, okay. Sorry,
No.
I did have a question beforehand, and I should have asked you this right at the beginning. Um, but just so I don't think there's a problem, but I'm concerned about the perception of conflict. Do you have a relative named Linda?
Maybe down the bloodline.
An aunt, perhaps?
An aunt that maybe I've met once or twice.
Yeah, that's what she says too. She's at Collier's, but that's fine. I'm just putting it for the record, and I don't think it's an issue. But
Okay.
we always we always have to go to the trouble of just stating that. And I've spoken to her as well. She said the same thing about you.
Gave
Okay,
gave you all the info.
okay, thank you. Those are my questions.
Thank you very much. Questions, Ms. Anderson?
I have no questions, thank you.
Thank you. Mr. Stephenson, questions?
No questions at this time, thank you.
And I have no questions at this time. Mr. Neufeld, would you like to walk through your report this morning?
Yes, well, I think you've got the gist of it. You renovate and you start all over again, and you don't make money until you stabilize. And stabilization can take, there's some projects we've seen stabilize in 4 to 6 months, and there's some that take 5 years. So in the period for which the legislation requires the owner to report, they had obviously not stabilized. And in our discussions with them, they said that they still have not stabilized. So perhaps in the future they will hit the numbers the assessor has drawn up, and but they didn't in this case. We use the income approach for all multifamily properties, and this is a phenomenon. We don't chase costs, because if they sold it April 1st, 2023, they're going to give a potential purchaser this statement that you have seen in, I think both of us provided the same statement that showed that they had a fairly significant there was a difference in the rent, and that's what it's going to be sold on. And I would point out that we've noticed another factor in that the market in multifamily is a bit at the low end of units has been a bit spotty. There have been increasing vacancies, and we may see it more today as we go through it, and I'll point it out to you. So if you were evaluating it today, we're stuck both legislatively and practically with a statement that says we're not at those levels yet. And the city can reassess in 2 years from now, and they'll play catch up, because I didn't write the legislation. You got to do it every 2 years. It's to deal with problems like this. And as far as the cap rate goes, on our first of all, and I'm going to, of course, not repeat myself. This goes for everything. On our page 45, we did find that the report that the city is relying on or has put in their evidence is not correct. We found a mistake on it. So if you look at the assessor's page 5, under multifamily, it's showing that Collier's is showing a range of 5% to 6%. That is not correct. This was it appears what happened is that when Q1 2023 was being sent to publication, nobody submitted new numbers in Winnipeg, and they replayed the numbers from 2022. And the actual numbers are more accurately reflected on our page 45, which is 5.5 to 6.5%. And then they did decline slightly. And this all relates to the interest rates, page 46. Interest rates, April 2023 were the all-time high peak. Again, I didn't select the effective date that the legislation called for the valuation, but when that date was selected, it was a higher interest rate than all the times around it. And it impacted a period of about a year of trading. On our page 40, so I'm just looking 49. We have a few transactions, and these are ones that Colliers sold. And I'll just point out for the record that we don't review income and expense forms that people submit. We get 3 to 5 years of statements, and we have a whole library of information that's gathered, the scope of any work and done, condition reports, work that has to be done. This is far more extensive than getting a mailer and putting the numbers in. And I'm not trying to be insulting. This is our job. We saw more apartment blocks than anyone in the city. And so a couple that we had sold on page 49, first of all, number 1, 441 Edison did not sell in the reference period. It ended up selling later, but there was a deal in Q3 2022, which was a 5.89% cap rate. The deal fell through because of financing. The new rates were the owner didn't like what he was looking at. However, when we stabilize, there's a couple of new things that you have to look at specifically in April 2023. First was the interest rate. If you had an assumable mortgage, what was the impact? And an assumable mortgage, most of these were at 1.75%, and new money was coming in at 5.25% to 5.5%. So if somebody bought and assumed a mortgage, there was a benefit. And yes, you do adjust for mortgage. We just haven't seen it in Winnipeg since 1982. That was the last time we saw drastic interest rates and the need to make adjustments. 1982 was the year of the 20% mortgage, and since then they've been stable, and most appraisers haven't bothered adjusting for preferential financing. And it's only been post-COVID years where you saw the interest rates that this has become a significant factor. And again, the city, I guess, doesn't do it. That's not because, but they should be doing it. The second factor is the school tax credit, and there was a change in the way it was applied in 2022. The payment came after the fact, and some people had it on their statements, some did not. In 2023, it was actually included in your property tax bill. So we have to go through and look and see the impact. Now, this number one, the property tax credit was $20,000, which bumps the NOI up because you're making $20,000 more. Now, on an interesting note, we don't think that this rate will be around. We're speculating the next budget we'll see a change in it. But the point is, we do this work, and this is a 5.89 on the potential purchase. The next one at 160 Lumsden closed March of 2023. Titles did not go through until October because they were putting the deal in order. There were some conditions that had to be lifted, but that was the day of the meeting of the minds. Same issue, had 1.75% assumable CMHC financing, and the school tax credit had to be allocated to the sale, 6.04%. These two properties are very, very similar to our subject today. These are also purchased by my client, so we have all the financial details. I didn't do the sale, but our brokers did, and we had to review their data, and we have our own data as well. This is an indication of when interest rates peaked, what the deals were going for, and they would go at a higher cap rate, except for one factor is that when we stabilize, we don't assume the high interest rates will be there forever. It's going to be for the rest of the term, whether it be 3.5 or 4 years left on term, and then there'll be a market stabilized rate. So if a mortgage typically lasts 20 years, so you have to prorate it over the life. So just to give you an idea of how we adjusted it, if the mortgage on Lumsden was carrying, I believe, around $4 million on the mortgage at a preferential rate that was 3.25 points lower than the market, that's a difference of $130,000 a year. That's how massive it is. Now, we don't take 130,000 and adjust it. What we do is we take 130,000, we multiply it times the 3.5 years left in term, and then divide it by the length of the mortgage, and we get an $18,000 adjustment. We take it over term, and that's how these were done. This is the way the market looks at it, and we are supposed to do market value. We also then had a few more sales on page 50, and these were not adjusted. So we did not have the financing information, and we did not have the tax credit information, but our source indicates that they were done on the basis of statements presented. So these ranged from 5% to 5.62%. Again, similar blocks. So you can see the difference that a prudent evaluator has to go through. Essentially, what we're saying is cap rates in this high interest period have to be about 0.6 of a percentage point higher than market indicators. And our market indicator at 5 would say 5.6. And it's fairly easy, and this is the way our agents do the work, and this is the way we look at it when we're doing appraisals. So we took the income stream and on a basis of 5.5%, the value is 1,827,000. Now the other workup below is the hypothetical. I'm going back to page 1. The hypothetical in when stabilization occurs. And we did not rely on this. This is just to demonstrate what the target is. You can't assess somebody or value somebody on their future. You can only do it on what happened. So I think our numbers, it's just an indication of all the impact of what a renovation project does. It's a loss of income for anywhere from 6 months to 5 years. And these are purchased for the future. And that's our case. Thank you.
Thank you, Mr. Neufeld. Questions, Mr. Michalak?
Yeah, so on page 49 there regarding the cap rate sales, I had looked at this information provided to the city of Winnipeg in the year before, and I got cap rates at 4.3 and 4.85 based on the information that they reported to the city as income. Now, would you agree though that because that's the way the city is doing their assessments, that that's how we should be treating the subject property in the same manner, and hence the cap rate sales in the same manner?
No, because there's a massive theoretical break in this concept. You cannot sell a property if someone says it's going to be a 4.3% cap. It just won't sell. So what we have is a system designed by our legislators that looks at backward-looking information and then tells you to apply a cap rate, which is at the time of sale. So I've seen the same statements that you're discussing, and we had them in our workups. What we noted on them was a fairly significant amount of repair and maintenance on the 2 years leading up to the sale. And so obviously the purchaser didn't walk in and say, I'm going to continue to have that. He's going to look in and say, look, the work's done. I'm going to buy it. I want my 5.6% return or whatever it is. And that's what I made my decision on. And make a long story short, I mean, I know the decision maker quite well. This is exactly what he said. These are professionals who they own 100 blocks, and they're not making dumb decisions. They made it predicated on 5.8 and 6%.
And just so these two properties here, you had said were be fairly similar to the type of properties that we're dealing with today. Would you agree that that's fair to say?
Yeah, I mean, it's a suburban 3-story walk-up.
Okay. Okay. So the price per unit on the first one is 147,000 a unit, and the second one 153,000 a unit. Are you aware that that's correct?
I didn't bother bringing that up or reviewing it.
Okay.
It
Okay.
has no bearing on our discussion today.
Okay. Oh, okay. All right. Those are all my questions. Thank you.
Thank you very much. Ms. Anderson, questions?
To confirm then, Mr. Neufeld, the assessment that you're requesting then is 2,114,000?
No, that was a hypothetical when it fills up.
Okay.
And when it fills up, it's going to be a couple of years down the road, so we have no idea what the cap rate would be. I think it's just an illustration. We're looking for 1,827,000, which is the actual income from 2022.
Thank you for clarifying that. Thank you. That's all my questions.
Thank you very much. Mr. Stephenson, questions?
I had that question that Gail asked, and then can you provide an average monthly rent per unit, Rocky?
Let me just see. I'm not sure if we worked this out, but they're speccing 272, and I'm looking at page 4, 272 on 23 units. Looks like they're targeting about 980. Oh, except no, wait a sec. I spoke too soon. That's the RTB registration. There's the residential discount has to be taken into account because that's the registration, not what they're actually going to get. Sorry, I just have to redo that number quickly. 272 is 253 divided by 23 divided by 12, 916. That's their target. It's pretty similar to what the assessor has.
Yeah, I think the difference really at the end of the day is the biggest part seems to be the cap rate. Would that not be true?
Well, it's absorption and vacancy, we'll call it. And how long will it be there? This is the only evidence we have. And then the cap rate, yes.
I had another question. Sorry.
Go ahead.
So a remediation, you're saying, should count towards assessment at that time, not a comparison to other properties in the market that are like similar values? Like, are we supposed to take it as a one-shot year, or are we supposed to take it as a running assessment of a value? I think you're arguing that it's a one-shot year on a remediation, and your 2022 expenses have like 850 grand in
No, that's not correct. Look down further. There's an adjustment on the 850. There's a positive and a negative. They're written in one area, and I was just looking at that earlier. It's just a rehabilitation scheme, 859, and then down below they put that into capitalized assets. So it's not reflected in the earnings. What we have to do based on the act is think of value in 2-year increments, and it's fluid. So if you do something physically to a property where you empty it out and you get an increase, above guideline increase through RTB, and then you have to spend the time to fill it back up, for that time period, it's going to be depressed. The next time period, which comes up with an effective date of April 1st, 2025, it's more than likely the site will be absorbed pretty close to where it's going to always perform. And then it'll perform at that level for, I don't know, 10, 12, 15 years, 20 years, until the next time something is required or not. So the point of we're making is that you make your decision on valuating that as of the market income in place during that time. So it's going to be a blip. You don't keep the same value all the way through, and it's a little bit harder in the multifamily world for talking to assessors about this issue. But when we have the same discussion, if say it's a residential, or sorry, an industrial property, and we just finished doing several of these where part of the building was obsolete, it was demolished and then rebuilt. So while it's being rebuilt and getting up and absorbing, they acknowledge that there's a loss in value. And it just seems to be that in multifamily, there's a concept that it's consistent, and so this is a departmental policy issue, I think, or way different departments in the divisions in the assessment department look at these sites. But ask yourself the question: I'm walking on the street, I want to buy your property. It's April 1st, 2023, and you made $100,000 last year. And the vendor says, we're going to make more next year. Well, maybe I'll come back then. I don't know.
Well, obviously the costs are isolated, but those costs could be spread out, like visualized as being spread out over many years as a regular part of doing business, right?
Yeah, well, the costs did not even impact the bottom line. They were all turned into capital.
And someone can choose to do all the suites or one suite at a time, or that's their choice. But anyways, no further questions. Thank you.
Yeah, that's correct.
Any further questions, Mr. Stephenson?
No, thank you.
Thank you very much. And I believe my questions have been asked and answered. So nothing further. Mr. Michalak, do you have any final closing thoughts on this?
No, I have no summation. Thank you.
Thank you very much. Mr. Neufeld, any final thoughts?
No, I think it's been covered.
Okay. And Mr. Neufeld, I'll ask the capitalization discussions that we've had.
You got it. I know what you're going to say. Yep.
Okay, so you're in agreement that we should roll that forward. We'll try and expedite the next 7 properties.
Yeah, you're just wasting time asking me. I was going to do it, but that's okay.
No worries. I got to just ask because it's a polite thing to do, sir. You know that. Come on now.
Okay. I just woke up. Okay, sorry.
Okay, don't worry. Mr. Michalak, could you walk us through 424 Osborne, please?
Yeah. So we have file number 24-4330, roll number 12015090000, 424 Osborne Street. Roll year 2025, assessed value 2,892,000, classification 20, liability taxable. We have a 1 building, 2-story built in 1962 with 21 suites. Going to page 2, they did sell for 1.8 million in 2017. and the location would be on Osborne, right across from the transit depot. If you're just trying to get a picture, again, another good location for renting apartments. Now, we see here on page 3 just the workup of the income value summary. So we're at 1,097 per unit, which is a gross rents of 276,598, effective gross income 267,747, with the expense ratio 45.46% to get a net operating income of 146,029, applying a 5.05% capitalization rate to get the value of 2,892,000 and a market value of just shy of 138,000 per unit. Now, if we look at some rent comparables here on page 4, so we see here just where this property would fall in line again with other properties built sort of in that time frame. Comps 3 and 4 are renovated comps. Now, I'm just going to get ahead a little bit. This property was renovated. You could see on page 8, they do describe it as fully renovated. So when you're looking at comparables, we're at 1,097.61. I mean, the renovated comps can each go from a 1,075 at a 1940 build, but a 1976 build renovated is 1,282. Rents there on 700 Corridon. So you could see that we're more than reasonable coming in on a monthly rent per unit on this one for income. And then cap rate again, we're just slightly above 5, which I think based on the information we provided is again more than reasonable. We see here page 9, we give their income value summary. So this property has been renovated. You could see the vacancy is quite low, minimal discounts. So they're getting a pretty solid revenue stream here, with expenses being pretty good. Pretty good management here by this company, and so you see their net operating income 167,327. So our net operating income is at 146,029. So we're being more than reasonable on the value here. I would like to believe, in fact, maybe slightly low. And then I just had posted the permit from page 11 back in 2017 that was taken out to do the updates. And so that would conclude my presentation. Thank you.
Thank you very much. Questions, Mr. Neufeld?
Yes, you mentioned the renovation. Do you have a date on that?
I don't know the exact date they were done, but I would say that they've been completed to this point, and the property is operating on that basis. Would that be unreasonable to say?
Well, no, we had a discussion earlier. So were you aware then, I'll lead you on a bit, that the permit was taken out in 2017 and closed in late 2018? Were you aware of that?
I was not aware when PP&D closed it.
Okay. And so that was, they've had operations almost 4.5 years after renovations of operations, correct? Based on that number date I gave you.
That's correct, yeah.
Okay. I don't have any other questions.
Thank you very much. Questions, Mr. Templeton?
No questions at this time. Thank you.
Thank you. Questions, Ms. Anderson?
I have no questions, thank you.
And I have no questions either. Mr. Neufeld, would you like to walk through your presentation, please?
Thank you. Well, I really like it when I say something and I don't put my foot in my mouth. Same ownership as the last one, earlier renovation. They took until it was actually they hit their recovery time. I was talking about absorption, and I wanted to just double check when that date was. It was I don't have it in my system, but it's consistent with what I said before. It takes a few years to absorb, and now you see that the income is hitting what the model generated. So we don't have an issue there. That's just the nature of the economics of real estate. So no concern on income. I think we're a few $1,000s difference, which is not. Oh, I do have it. I just want to. I opened the wrong file. No, I don't have it. Okay. So it's just the capitalization rate, and what we're talking about is the same issues as before. I don't agree with what was here for 6.75%, but the issues that the person who drew this up were bringing forward were that it lacks a full amount of parking stalls compared to the number of units it has. So it's in the suburbs, which means the building, the bylaw requires 1.4 stalls per unit. Now, as an older building, their 13 stalls are what's called legal non-conforming. But the downside, as I keep saying on this, is that it's a restriction on earning power, because if you're hoping to get big high rents, you're going to be dealing with a socioeconomic group that drives cars, not one that takes buses. And this isn't any indictment or criticism of the way people live. It is what it is. So your target audience takes buses, they earn less money, and that's a downside in your earning capability. If you have more parking, you have a greater upside. These are all small adjustments that were made. For example, that would equate to about 0.2 of a percentage point in the cap. The mix of units is not the greatest. It's 3 bachelor, 15 1-bedroom, and 3 2-bedroom. That's our records that we have. The optimal is a healthy mix of 1-bedroom and 2-bedroom units, and that's again a minor issue that we bring forward all the time. If you're looking for the best rates, then you should have the best mix. Building size is a little smaller, and I didn't bring that in on the other one because the issues were different, but the optimal building size for expense ratios is 30 plus units, and that's an indication of the difference between variable costs and fixed costs. So a variable cost goes with the income coming in. Every unit has a share of taxes, a share of utilities. They're based on the number of units, where the fixed cost would be certain repairs on singular items, say a central boiler, or entranceway systems, or accounting, or legal, all the fixed costs. So it's when you and this also is a vacancy issue. So if you have one vacancy with 20 units, you're at 5%. If you have a one vacancy with 40%, you're at 2.5%. It's just less riskier. So it's the issue there. I disagree with the rate, though. I was going back and looking at our evidence, and would suggest that a rate around 5.75 is more reasonable. It is in what we call a good rental neighborhood, in that there's people who want to rent it, and you're in your right market. So that value, we've revised that to 2,607,700, or well, actually we'll round that to 2,608,000 at 5.75%.
Thank you, Mr. Newfeld.
Yeah, that's it.
Questions, Mr. Mickelson?
Yeah, just a question about the expenses that you show. The expenses you show for 2022 say 120,107, but on their income and expense statement, their expenses in 2022 show 102,721. Like, did you adjust for anything else in that to get 120,000, or was it maybe a calculation error?
No. There's some, I'm looking at the non-operating costs, the expenses. So the 102, you have to then include professional fees, legal fees, service charges, and an admin expense. So I think that that's the difference. I can't read the small print, and I haven't done the math on it, but the expense you're discussing is there are more expenses down the line on this.
Because I'm seeing a total for expense that also includes management fees at roughly 5%. It still comes out to 102,721, and you have your net operating income of 167,327. So I was just curious, like, did you like
No, there are there
so you're including more. That's just you're including more than that?
Well, the way people do their accounting isn't the way that we do it for appraisal. We have to go through it line by line.
Right.
So I apologize. I can't read the small items, but I can see that there were some non-operating expenses that are legitimate expenses. Other operators will put them above the line, and the reason they've done it this way is this company owns a portfolio of commercial properties and multifamily properties, and they're likely using the same software on it, and it automatically goes, we'll call it below the line, but in apartments, it should always be above the line.
Those are all my questions. Thank you.
Thank you very much. Ms. Anderson, questions?
I have no questions. Thank you.
Mr. Stephenson?
No questions at this time, thank you.
And I do not have any questions. Thank you very much, gentlemen. Unless there's summation, I'm assuming there's not.
I'm okay for summation. Thank you.
Mr. Newfeld, you're good?
I'm just going to repeat something because I was happy that, like I said, I didn't contradict myself. Same owner, renovated earlier, absorption proved that eventually he's going to hit the number the city has. And it validates the concept that you're going to have a downtime, reassess every 2 years. That's what we all live with. And then, of course, a real cap rate derived by people who sell properties. Thank you.
Thank you very much. Mr. Mickelson, could you walk us through 633 Manchester Boulevard North, please?
Yeah. Okay, we have file number 24-4323, roll number 030-818-49100, 633 Manchester Boulevard North. Roll year 2025, assessed value 1,650,000, classification 20, liability is taxable. We have one building with 3 stories, similar to the other types of properties that we've been discussing. Built this one in 1954 with 17 suites. It did sell back in 2015 for 1.5 million. The location would lead you to a really good neighborhood here by the Wildwood area. So it's a good, quiet neighborhood and very popular for rentals. Now we go to page 3, so you could see our income value summary here. coming up at 819.53 per unit, which leads you to gross rents at 167,184. Effective gross income 162,001. Expense ratio 50.08% for net operating income of 80,871. Using a 4.9% cap rate gets you the value of 1.650 million and just above 97,000 per unit. Now, if we look here at the rent comparables, so of other similar type properties in the market region, you could see where it falls in line with other properties, with the range being from 886 to 962 per unit. And then this one's 819, but you could see that it's from a income perspective, we are okay. And capitalization rate, we have already discussed, just on page 8. If you look here at the apartment, just from the website. So as Mr. Neufeld touched on, the same owner, this is the same owner as the prior couple. We see it just says 3-story walk-up located on Manchester at the end of a quiet cul-de-sac. New countertops, new air conditioners, renovated common areas near schools, bus routes, etc. Heat and water included. Pet friendly. So there has been, I assume, some modest renovations, but maybe it's not a full-scale one. I don't have pictures of it. When we look at their income, though, here on page 9, we can get a picture that the vacancy again is quite low. Residential discounts are given. The total income at 174,080, and our models at 162,001. So we are acceptable there. And when you just look at the expenses, we come up with the expenses here are 77,275, and our models at 81,130. So realistically, we are a little bit lower on the income. Again, based on the cap rate discussion we had, we feel that our cap rate's totally fine, and on a market value per suite basis too, I would say that would more than line up as well. So we feel comfortable at the value we're at on this one, and that would conclude my presentation. Thank you.
Thank you, Mr. Michalak. Questions, Mr. Neufeld?
Yes, you brought up a 9-year-old sale. Did you research it?
I did not look into it, as I assumed. Well, you know what? I shouldn't say I didn't research it. We had accepted the sale on our end, so I didn't see an issue with it. Was there a problem, or do you have more to add, since you might have more knowledge of it?
And so you didn't look into it. No, that was my question of you.
Okay. And I mean, being in 2015 and we're in 2025, I really didn't put a lot of weight in using that
Did you
towards.
provide the board with an overhead view of the lot?
What's that?
Did you provide the board with an overview photo of the lot? And I am just looking through your report.
No, it doesn't have an overhead view.
Okay. Obviously, you're not obligated to do that, but I'm just wondering if there's anything unusual you'd like to note it about the property.
I mean, it's located at the end of a quiet cul-de-sac, like the website says, so I don't know what more.
Does the roll contain an additional non-contiguous lot?
I wouldn't be able. I'm assuming, since you're asking the question, that maybe it does. Would you care to expand on that?
No, don't go guessing and trying to go ahead. I'm just asking you what you know.
I I do not know.
Okay. Okay, I just wanted to get the groundwork there on that, establish that you did not look into it. Sorry, and I accidentally closed was that 4323 was the file number?
Yeah.
Okay, sorry, I accidentally closed it. Um, And did you have a date on this renovation?
Like I said, I didn't say that it was renovated with a permit or anything. I was just reading off what the website had said. So I don't have a date on anything.
Okay. Those are my questions then.
Thank you very much. Mr. Stephenson, questions?
Can you just run through how you determine the cap rate again, please?
Yeah, so just based on the cap rate's all model driven, right? And then so if it's 4.90%, we feel that that's still reasonable based on the cap rate evidence that we've supplied on page 6. We feel that these sales were stabilized the same way that our assessments are produced. So which is looking at historical income that's been reported up to a sale date. And so we feel that at 4.9% is reasonable, and given the neighborhood and location, I would think that that's also reasonable.
Thank you. No further questions.
Thank you. Ms. Anderson, questions?
I have no questions. Thank you.
Thank you very much. And I have no questions at this point. Mr. Neufeld, would you like to walk through your presentation?
Thank you. So the physical layout on our page 1 is it's not as clear as it should be either. But there's a red dot on the roof of the building. Then the lot across the back lane, a wide, shallow lot where there's 2 cars parked. That's part of the same roll.
Okay.
So when I was when they originally bought the site, that was the problem of having to acquire that piece of land for their parking, and they paid a premium for it. So the sale ended up not being market because they had some difficulties. They were committed and they had to buy it. I just want to ask people bring up sales. I kind of cringe and think, well, you should have probably looked into this before you talk about it. The site was renovated shortly after the sale, and it has been complete for quite some time. And again, it's the same ownership. Getting back to what I said earlier about the recently renovated site in the first property we heard is this one is now hitting a stabilized rate, and you can even see that our NOI is higher than what the assessor had because we use the actual. Now the cap rate issues have to do with a couple of other things. I mentioned earlier that it's small is bad, and that's true. You say you have a great location in Fort Garry, well, but it's got bachelor units. And again, I always worry that what I say can be interpreted the wrong way, but Fort Garry, near this part of Fort Garry, is not where you would generally see a good market for renting bachelor suites. That's I'm trying to phrase this in a way that without saying anything, but it's the wrong fit for this market. What they should have done with this is blown out the 6 bachelors and turned them into 3 2-bedroom units and had greater income off it, because that's what you're going to get here. And again, it's a small unit count. The difficulties with the parking are the fuller picture it doesn't show, but this was a lot that was created as a result of needing a back lane, and then sold for the surplus, and it was an original building lot. And to maintain this, parking is an ongoing struggle. And we don't really prefer to discuss the intimate details, but it's a difficulty right now. It's a question mark. And that's all I'm allowed to say about it at this point, but it impacts the cap rate about being able to maintain that lot. The workup on it again deals with the parking issues, and I think that the cap rate we've applied is on the high side, but it expresses the risk that we have for maintaining this parking lot situation. It's a surface parking lot, and if you look at the design of it, the bylaw now calls for surface parking lots to have one point of egress access. And so one of the debates early on was, if you have a legal parking lot, you got to fence it and put one entranceway into it, which means we'll get 3 cars in there, not the parking that's there, if it for permissible use. So it's, like I said, it's an ongoing struggle, and it's a residential neighborhood. They don't want to see parking lots there. I think based on the uncertainty, if this were not an issue with the parking lot, we would cap it lower, but there are ongoing concerns, and we're going to leave the number as is. We're using higher income, but a big question mark on the continued ability to park on the site. That's my presentation.
Thank you. Question, Mr. Whitlock?
Yeah, just regarding issues like you had stated about them being bachelor units, etc. But looking at the vacancy, it appears that the vacancy is at 1.9%. So would that, like, the property does have good demand, does it not?
Well, I talked to the owner, and there are issues with it, and he has concerns with it. So I don't know where you're getting your information from, but I've got it directly from ownership.
Okay, I'm just basing it on the income statement that they are showing 1.9% vacancy. So I just, it doesn't seem to add up that they have all these issues with it being a bachelor and there's more added risk, etc. If the place is being rented and it's in demand, I don't see where the added risk is. But
And
those are all my questions.
I'm going to answer that, and I'm not being disrespectful, but I don't think you've been in the business of buying and selling properties. You're looking at pieces of paper people give you. There's more to it than that.
Okay, and so I'll just say in that regard to further, the subject properties that we speak about are all based on these submissions to us. So I think it's only proper appraisal methodology that we're applying things the same way.
No, that's incorrect. You can't
So I
hide.
will say that in our end, that is how we approach it. And so we feel that we're using more than reasonable approaches to how we're determining value.
I'll treat that as a question, and it's incorrect. You're not using appropriate appraisal methodology, because we are required as appraisers to go out and do due diligence and properly investigate, not simply take a piece of paper. It is a mass appraisal technique, and mass appraisal contains flaws, and it's accurate 19 out of 21 times, and this is one of those times it isn't accurate.
Those are all my questions. Thank you.
Thank you very much. Ms. Anderson, questions?
I have no questions, thank you.
Mr. Stephenson, questions?
So you're saying the parking lot negatively affects the value?
Well, the ability to keep it maintaining, and I can tell you a bit more about it. So there was a school, or is a school next door. So this was the old school lot.
My kids went to that school.
Okay.
I know this well.
Yeah, so they got the lot from the school. So when it was a school lot, there was no problem with it. It's going to be grandfathered into I mean, no, it's an institutional use. You're allowed to do it there. They took it private, so they've had ongoing difficulties with maintaining the lot. Is then that school? I don't even know if it's still active.
Yeah, Oakenwald School is, yeah.
Okay.
And then I think there's there's parking behind the building on the lane, and then there's also parking on the front street.
Right. They've
I
got
thought the
west.
problem would have been that the people attending the school would always park there, and that was always the ongoing issue, I thought, but.
Well,
fencing.
yeah, that as well. It is their lot, but there's lots and lots of issues, and they don't. You can just imagine what they are. They've asked me not to get into that because
I guess I look at it like it's a bonus that they have that extra spot attached to it to give parking for the building, even though there is bus service within a stone's throw from the building too that takes you downtown, right? So
yeah, but it's the risk of being able to continuously use it. It's not attached to the building. It's not part of it's not a contiguous piece of land, and
doesn't it front onto the green space that is
well,
part
it
of
faces it on the east-west side. There's a little bit of green space, and then there's the playground area. That's correct.
Yeah.
But the green space is actually is a city right of way for the lane. So it's like a little island in the middle. You see from the sketch.
Yeah, it appears as though it's part of the part of the property, but maybe it isn't. Yeah, maybe it's just
Well, the sketch on our page 1 shows where the cars are parked. So it's surrounded by city-owned land. From the lane, the blue lines are lot lines, and this is the sliver in the middle.
Okay, no further questions. Thank you.
Thank you. And I have no questions at this time either. No other summations quickly, gentlemen? No?
I don't have summation, but can I just take 5 minutes to step out quick for a washroom?
Okay, Mr. Neufeld, you are, no summation at this point, yes?
No.
Perfect. We'll take a quick 5-minute recess and we will reconvene in 5 minutes. Please, thank you. Thank you very much. Mr. Nicola, could we move on to 1088 Corden Avenue now, please?
Yep, absolutely.
Thank you very much.
We have file number 24-4363, roll number 120-305-74100, address 1088 Corden Avenue, roll year 2025, assessed value 1.949 million, classification 20, liability taxable. We have one building, 2 stories, built in 1968 with 18 suites. I do have a recommendation here to revise to 1,823,000. Would that be accepted?
1,823,000, you said?
Yes.
Based on what?
Using 89,346 adjusted NOI and our cap rate of 4.9%.
So 89,349, you said?
89,346 NOI.
Thank you. Mr. Neufeld, what are your thoughts?
I'm just looking it over. Thank you very much, but no, we'll have to move on.
Okay.
Fair enough. Continue on, Mr. McClung. Thank you.
Okay. Absolutely. So it's located on a Corden Avenue towards the Rockwood neighborhood. So again, another good location for rentals in the city, close to bus routes as well, for a lot of the clientele that may be renting these type of places. We see here on page 3, so we have our income value summary workup, so 206,349. Effective gross income 199,746, and I had made the adjustment that I had mainly come from had been with the expense ratio. So I had adjusted the expense ratio to 55.27, and it was based on what has historically been reported to the city of Winnipeg. And so the new revised value again, we would say was, let me just find it again, 1,823,000. And so we had touched on how I came up with that number. If we want to go to page 8, so I had just supplied some information based on there was a sale back in 2013. So this was the sales ad, just what it was marketed for back then. It had just had some comments about it, which was saying diversified mix of 1 and 2 bedroom suites in a 2.5-story walk-up style apartment with on-site parking, efficient suite layouts featuring large windows, ample in-suite storage, excellent location along Corridon Avenue within walking distance to Corridon Village and Grand Park Shopping Center. And it had said it's well suited for rehabilitation and conversion to a higher rental standard. There was a inspection that we had done back in 2017. I was not the one who did it. These are pictures we have on file. So this is sort of back in 2017, what some of the pictures were. You could see, so some modest updates, nothing too significant back then anyway. And then if you go to page 10, they do have I did show the income statement for 2022. So they are getting 178,784 of income, but the total rents, gross potential rents they have listed are 234,840. The owner here, like, there's no listing of vacancy issues, so I'm not sure if this is a situation where there is vacancy and they're updating significantly, or if this is maybe posted rents and this is the rents they're actually getting. I mean, in that case, there is significant upside potential. Then I think we could reasonably say, as a purchaser, if you were looking at it, if there's that big of a gap. But looking at the expenses, I mean, repair and maintenance, 22,326 on 18 units doesn't seem too out of line given the type of building that it is. So, I mean, that's where I went with the recommendation. I think the rents we have are okay, and it does fall in line on page 4 with rental comps I provided with other properties, and I've provided other ones that are on Corridon Avenue. So I don't see any issue with where we're coming in from an income side of things. And then cap rate 4.9 we had touched on already, where the department lies on the cap rate. And yeah, so I think my recommendation is more than reasonable, and that would conclude my presentation. Thank you.
Thank you, Mr. Mikulik. Questions, Mr. Neufeld?
Firstly, you mentioned a sale. Now, did you research that sale at all?
I did not research it besides posting the rental ad.
I see. So you weren't aware it was between related parties?
I do not know the parties, no.
Oh, okay. And the original valuation, page 3, was done by the model. Is that correct?
That's correct.
And I'm sorry, you may have said it, and I'll make you repeat it. The adjustment this is listed page 10. The first was an expense ratio to 55.27 originally from the 52.19 in the model.
That's correct.
Okay. And so that was the only change. It was an adjustment of the expense ratio.
That's correct.
Okay. And was this your adjustment?
This is what I had proposed, correct?
Okay. And I may have missed it. I'm still trying to wake up here, but what was the reasoning for adjusting it?
I felt that we would adjust the expenses a little bit higher based on the reporting.
So a review of the actual is what you're saying then?
That's correct, yeah.
Okay. Okay. I have no more new questions. Thank you.
Thank you, Mr. Neufeld. Mr. Stevenson, questions?
No questions. Thank you very much.
Ms. Anderson, questions?
I have no questions. Thank you.
And I have no questions at this time either. Mr. Neufeld, please walk through your presentation at this time.
Thank you. So earlier in our hearing, I mentioned something about the market showing slippage. And if you look at what's been declared past 3 years prior to April 1st, 2023, as a decline in income, this isn't a one-off. This is what the market, this type of property is seeing, and more product on the market, some newer, superior built property in the market. And for the first time in a long time, Winnipeg's showing much higher vacancy rates. The only thing that mitigated this was the refugees that we were taking in, who have filled some of the vacancies that came in, and that was just a fact of the market. This is how it works. But clearly, there's a decline in income, and the decline in income, if you'll note, is accompanied by a decline in the expenses, because expenses are, in this case, partially variable, partially fixed. What we ended up doing to stabilize this was, normally, the last few years when we've been doing hearings, we always take the last year of income because revenue's been growing. This time we chose the average, which is higher than the last 2 years, but it's a reasonable assumption. But we have to change your valuation when the market changes, and it's to account for the market drop. The expenses are averaged as well, and this gets us an NOI of 73,677. This is extremely reliable. This is what it is to operate the building. And when I looked at the assessor's recommendation, I guess that was what really threw me off, is that you can't manufacture NOI on an opinion. It is what it is. Now this, going to the cap rate, the issues that we were looking at were all listed on page 2. But again, I'm going to make a revision here because I want to be consistent. I would point out that this particular owner, it's not the same owner you heard from the previous 3. This is Smith Agencies. They own 100 blocks in the city. And on our page 38, sorry, they were the company that bought those 2 properties. So my strong feeling on this is, this isn't a model. This company tells us who the cap rates are, because they're buyers. They're paying 6% for properties, not whatever somebody gets them on a model. That's the true test of the cap rate. So I'm just going to adjust our cap rate to 6% on the actual income. 73,677. That 6% is 1,227,950. 1,227,950 rounded to 1,228,000, and our actual income at 6%. I'll point out that the previous year is under appeal, and that's because they're chasing the sale. This was managed by the current owner prior to sale, and they made an internal deal to buy the property at the time because they were already managing it. So that it's not something that should be relied on. And we've had some issues with this. This is about the only property we have for Smith where we have ongoing issues with having to go to municipal board, but because there's sale chasing, and bottom line, call it final say, final argument. We value properties, multifamily properties, on their income, not their sale prices, not their cost per suite. And that income changes. It's variable, as this one demonstrates. It follows the market. The market wasn't designed for someone's convenience so we can have an increase every year. It goes up, it goes down. We've seen two factors in the multifamily market showing downward value. One is the clear income on this site decreasing, and the other is the increase in interest rates, which puts pressure on having a higher cap. And 1982 till 2021, we saw pretty much growth every year. But now we're seeing some stagnation and some declining values. That's my presentation.
Thank you very much. Questions, Mr. Whitlock?
Yeah, I just have a question. So, are you able to expand on the rents that they've reported? The gross rents to us is 234,840. Are you able to expand on why the
Can you
income's
tell me
170?
what you're referring to?
Well, I had supplied their entire income statement that shows their annual income being
So you're saying
two.
why does page 11 differ from page 10 on your report? Is that what you're trying to say?
Yeah, page 11.
Okay. So every operator every year have to go to the residential tenancies branch and register every rent on every unit.
Okay.
What they do is every year, every operator applies at residential tenancies for an increase on the book.
Okay.
But that doesn't mean that's not what they charge. So
Okay.
at RTB now, they could potentially get 234,000 in income,
Okay.
but the market is only letting them make 178 because they don't rent at the RTB registered rate. You'll find that when you get these handwritten forms, which are Smith Agency, this is the way they do business, and it's reasonable when you understand it.
Now, so would you say with that being registered to RTB, a purchaser, there's a high degree of income growth potential in this property?
Absolutely not, because you saw it's been declining.
Okay, so
A registration, you can't make people rent. You can't make it make money. You've got to wait for the market to show it. It declined.
So when I look on your page 2 of the chart that you've put together, you have the income growth potential of the subject being 10 out of 10 and the tenant strength being 10 out of 10. So I just kind of getting confused here. If they have rents that are posted at that rate, what's to stop them from trying to maximize that growth potential?
Vacancies.
So the tenant strength says 10 out of 10.
Well,
So
you'll find in most cases when we do this, unless there's a problem with the revenue stream, we'll always put multifamily at 10 out of 10 because that's the way investors regard it. So there's no issue that it's going to be stable and it's going to follow the market. but the income stability is not there, as shown by the decline. And the writer put in consistently high R&M. That's incorrect. It's declining revenue should be there, but it's the same observation that there's no the income isn't stable.
You didn't supply a rent roll for the property, did you?
The rent information provided is what they have on record, and the same thing that you received, and it's been relied on by the city assessor for how long have I been working for them? 16 years.
Okay. No, those fair enough. Those are all my questions. Thank you.
Thank you very much. Questions, Ms. Anderson?
I have no questions. Thank you.
Thank you, Mr. Stevenson.
No questions, thank you.
Thank you very much. I have no questions either. Unless there's summation from either one of you gentlemen.
I don't have summation. Thank you.
Mr. Neufeld?
I'm just going to repeat what I said earlier, that when you're contemplating a cap rate, most creation of cap rates is done outside of the actual practice of the transaction. And, again, I'm not being overly critical of the assessment department, but that's what they do. They don't sell properties, they get questionnaires and they work it out based on the information they have. But that's not the law. They don't set cap rates, the market sets them. You have an operator here who bought 2 buildings in and around the reference date, 6%. They set the market, and that's the best evidence. Thank you.
Thank you very much. Moving on, 88 Killarney. Can we have your presentation on this, Mr. Nicola, please?
Okay, we have file number 24-4317, roll number 030-424-26000, 88 Killarney Avenue, roll year 2025, assessed value $3,004,000, classification 20, liability taxable. We have a 1 building, 3-story, built in 1971 with 23 suites, and there was a sale back in December of 2015 for $2.250 million. This property is located in the Fort Richmond neighborhood, so it is really close to University of Manitoba, and again, another great location for rental demand. We have average monthly rent of $945.68 per unit. And when we look at our model summary here, the gross potential rent $261,008, effective gross income $252,917, with our expense ratio 45.96%, to give the net operating income of $136,676 with a cap rate of 4.55%. Gets our $3,004,000, and the market value per suite coming in at $130,000, just shy of $131,000. Now, if we look at some rental comps in the area, you could see that they're all on the same street. We do have some effective year built on this one, factoring in that it has been updated, and you could see the comps here where it falls in. We're at $945.68 per unit, and then they range from $962 to $1126 per unit, all in that similar effective year built range. In terms of the property itself on page 8, so just this is again managed by the company of some of the prior ones we talked about earlier. So it's a 3-story walk-up located 88 Killarney in the heart of Fort Richmond, fully renovated. This building is perfect for university students, close to the U of M, steps away from major bus routes. Original restored hardwood floors give this property unique character and charm. Pet friendly, heat and water included in the rents. If we do look at the rents here, you could see that in 2022, the properties low vacancy, so the rent's 287 472, the vacancies 2097, so really quite low, and the discounts being 446.28, so minimal there. You have a total income of 291,959. Our department's coming in at 252,917. So I would say that we're actually kind of low on that end, and so in that regard, we're being reasonable there. And the net operating income you could see down on page 10 comes out to 185,037 per unit, and or sorry, 185,037 total. If you look on page 3, we're at 136,676. So we're off by about 50,000 on the net operating income. Now, I would suggest, so it's going to get pointed out that the cap rate's low. But again, when we look at, when we circle back to the total value as a whole and the market value per suite being 130,608, we're more than reasonable, and I think that's even supported at that unit rate based on the sales that Mr. Neufeld had supplied, being 147,000 a unit and 153,000 per unit on those types of similar type properties. So that would conclude my presentation. Thank you.
Thank you. Questions, Mr. Neufeld?
I was going to say that if I hadn't slept in, I thought we were supposed to do this at 5 o'clock. Was planning on withdrawing this property. Can I do that now, or do you want me to confirm it?
Well, I think we can just have you, if you'd like to withdraw, we can at that point. I don't see why we can't.
Yeah. Okay. Okay. I imagine there's something that's going to get emailed to me, and I'll send it back. And
Yeah, just a moment. Okay, maybe we might have to have you just confirm, say.
Okay. Well,
And
that's
we'll
fine.
Because we've already started it. Had you said something right at the very beginning?
Yeah. Okay.
My apologies.
No.
And sorry, Mr. Whitlock, we got you to run through your whole presentation. All right,
Total
so,
sleight of hand.
yeah, no worries. So you'll move to confirm then, correct, Mr.?
That's correct. Yeah.
Okay.
Okay, so we're going to 12:30 Pembina now.
Yes. Just give me a moment. 12:30 Pembina Highway. Yes, please give us your presentation, unless Mr. Neufeld, you have a withdrawal on this.
No, I don't. Well, I was going to review them in the afternoon for the 5 o'clock hearing, and I just woke up, so I don't know. I'm looking through them all as I go along, and I certainly don't want to waste anyone's time.
I appreciate the thought on that, Mr. Neufeld. Thank you. Go ahead, Mr. McLeod, please.
Okay, so we have file number 24-4383, roll number 0309 000 1230 Pembina Highway. Roll year 2025, assessed value 1,293,000. Classification 20, liability is T taxable. We have a one building, 3-story, built in 1953 with 14 units. Location wise, you could see where it's located on Pembina Highway, which is kind of just before Bishop Grandin area on Pembina. So again, down towards the oh no, this one would be, sorry, This is more closer to where the one we had spoken about in the Wildwood neighborhood, but this one's located just on Pembina Highway instead of reseeded back into the Wildwood neighborhood. But still a good location for renting, and being right on bus routes, etc., sees good demand. Now, when we look at the income value summary here on page 3, so we're at 904.66 per unit. Gross rents which works out to 151,983. We're using a 56.11% expense ratio for a net operating income of 64,638. Capitalization rate being 5%, bringing that value to the 293,090, just above 92,000 per unit. When we look at the comparable rents of other properties in the area, so we see here where it falls into other properties on Pembina Highway being built in that same time frame. And we see here we're at 904.66, 1626 Pembina Highway, 910. 75 Killarney, 962, 1430 Pembina, 1037. So we have a range to support the income there from the model. If we go to page 8, so just showing you an outside picture of the building that we're talking about on Pembina Highway. So you could see it looks fairly well maintained. I don't know how much renovation there may be done. I know it says here there's no availabilities at this property, so I would assume that there's pretty good demand. Now, when we look at their income statement, again, this was one like the one we had spoken about on Corden. I assume it's that same ownership group, being the way it's filled out. And I think the picture even says Smith, oh yeah, Smith Agency, which Mr. Neufeld had touched on, owns these properties. And so, again, we see a situation where the rents are registered, I guess, at 183,336. The income they're getting is 155,109. Now, when you look at the expenses though here, so the R&M is actually quite high at 2,000 per unit. I mean, I haven't inspected it, so I don't really know what's going on in terms of, are they updating the suites or have they been updated, but it's run historically high R&M. I mean, I don't know what the breakdown of those costs are going to, but if we just did 1,500 per unit R&M, this NOI would work out to 67,496 based on the actual reported. So, you know, the model's at 64,638. When I see that the R&M at 1,500 per unit, which is, I think, being quite generous on the high end, I think we could agree, even if those sales that were provided by Mr. Neufeld, the R&M on those sales, I know wasn't touched on, but I could imagine those R&M on those sales, 1,500 per unit would probably be very reasonable in terms of the marketplace of the sales. So when I see that, and again, page 11, I just shown again their income statement on page 11, maintenance and repair, 34,378, which is getting upwards of almost 2,300 per unit, which again is really quite on the high end. When we bring that down to a more reasonable level of 1,500 per unit, we get a NOI that's, I think, justified in terms of what our model's giving. So based on those parameters, I feel the value is reasonable, and that would conclude my presentation. Thank you.
Thank you. Questions, Mr. Neufeld?
Just the value is as done by the model, and that's what you're showing on page 3. Is that correct?
Yes, that's correct.
What's the factor that the model uses for adjusting the expense ratio? What are there a couple of primary factors on how it's done?
I don't work there in that section, so I don't have their
Okay.
workings, so
Do you have any idea if they'd make an adjustment then on the basis of the number of units?
I wouldn't be able to answer that question. I'm sorry.
Okay. You made some, but you did venture out and make some statements based on your assumptions that the R&M should be lower. Do you have any evidence to support this?
I believe based on sales that the water department has submitted, these sales here on page 6, the R&M of these sales are all below 1,500 per unit and lower. So I just
Which,
thought it.
which sorry, which sales you're referring to?
Well, page 6, we've stabilized those sales on
Okay.
page 6 for cap rate. So when we review these sales, again, this is on income that's reported to the city of Winnipeg in terms of how we derive our cap rates. It's been touched on a number of times in this presentation. Expense ratios of these type of sales are typically going to be in the mid 40s and lower, and repair and maintenance is coming in usually 1,500 per unit and less. So I think I've done a reasonable job at going on the higher end of that.
I wasn't quite the question, but you brought up a point. I thought you said that 1,500 was applied. Are you saying that's the way I thought I heard it? Are you saying that 1,500 was in these statements?
1,500 was when I reviewed the income of the property when comparing what's been reported as their net operating income. And when I look at our model net operating income, I would venture out to say that I used 1,500 per unit R&M, which is I think on the higher end. And it's also on the basis of like there's no
Okay, sorry, I'm not asking
pictures
about
here of the
I'm not
property.
asking
Like,
about your
what are they
opinions.
doing with repair and maintenance that's, well over 2,000 per unit when we've been discussing these similar exact buildings today that are having repair and maintenance that are closer to 1,000.
I'm sorry,
So
your answer is non-responsive. It wasn't what I asked. I'm trying to find out if you have reported repair and maintenance in writing somewhere, not presented, on these sales you brought forward on page 6 that indicate 1,500 per unit.
no.
Okay, that was easier to answer. Um, do you,
Gentlemen,
now you have gone and provided statements. I'm looking at page 9, page 11, page 13. I take it that's what led you to make the statement that it's had historically high repair and maintenance costs?
Yes.
Okay. And so you're suggesting to the board that an assumption that it should be lower is better than the actual facts. Is that how I read this?
That is correct.
Okay. Um, those are my questions. Thank you.
thank you, Mr. Neufeld. Ms. Anderson, questions?
I have no questions, thank you.
Thank you. Mr. Stephenson, questions?
No questions, thank you.
Thank you, and I have no questions either. Mr. Neufeld, please walk us through your presentation.
Thank you. Well, I've got a history on the property going back to 2008, and the repair and maintenance have always been high in this location. And what this goes back to is what I was saying earlier about one of the issues on physical issues. There's 14 units, so you have fixed expenses, you have variable expenses, and the smaller it is, the greater the impact from the fixed expenses, and that's why it's running at a higher rate. There's 2 doors in this building. They got to fix them. Well, there's 2 doors on a block that's got 100 units. I like that example because we can think of that in concrete terms. It might cost you $3,000 to put a new door on an apartment block, you put it on this one, the allocation is $200 a unit, and on a big unit, it could be $10. So that's why the costs are high. They've been high for the longest time. The income on this one, this is owned by the same one in 1088 Court, and I mentioned there that they had a decline in income, and here they had growth in income. And the difference being is that they do get a different clientele here. Obviously, the university plays a major function in this. And if I were just to add an aside, I remember from my days at U of M, and we had a lot of parties and wrecked a lot of apartments. So I'm just putting that forward. That's probably could be a factor. But the income is what it is. Now, in this case, because we had an increase in income, we used the last year of income because it's showing a stronger tendency. We don't do models. We do what it actually is. So we've used 155,000, and the expense side, we averaged it out because expenses can go up and down. In this case, they were relatively consistent through the years, and that gets us to an NOI of 58,248. I think that's a very, very valid number. And again, the cap rate, this is the same company that bought 2 units at 6% in the reference year. So 6% should be reasonable. So I would just adjust the cap rate to 6%. And one of the reasons I'm doing this is because they do have a consistency of approach to their operations as well. So they will approach it with the same management style of their other units. So there's an expectation that that's the return. So the value is actually 970,800, rounded to 971,000. I don't think I have anything more to add to this. Oh yeah, well, just the neighborhood. It's I guess most people know it's like it's near Clarence and Chevrier on Pembina, so it's south of McGilvery, north of Bishop Grandin. I can't remember if it's closer to Chevrier or Clarence, but it's right in that area. That's my presentation.
Thank you. Question, Mr. Nicola?
Yeah, just regarding this property, like, have you been inside of it, and do you have any pictures to show just the state of what it looks like?
I have been in it, and I don't remember when.
Yeah.
There's an incredible consistency with these Smith properties. They're kept very, very consistently across all their 100 operations. So you walk into one, you're walking into the other. So they'll be well looked after. They repair things and keep standards up.
Yeah.
No deferred maintenance generally. They get on things right away and fix it.
Okay. Now, does this property, like, are you aware, do they have vacancy issues? I don't see anything being reported. They have pretty stable income, correct?
Well, we saw a jump in 22, and between 20 and 22, we ain't going up 10%, so it's an average of 5% a year. I'm just looking through some older information here, just to see if there's a reason for it, and or anything that's standing out. I don't see anything. The site has had a greater revenue growth than many places, and I don't know what else to say. I'm just wanted to find one more thing here. That's this statement. Yeah, you see on this one, I'm looking on the assessor's page 10, the registration is at 183,000 with
Yeah,
RTB.
yeah,
And so this is a situation where the market has indicated that um, that they can get higher rents.
um, and then so 62.45% expense ratio. Is that like an expense ratio that Colliers would market if this property was put up for sale?
Absolutely, and one of the things on the expense ratios that we have to be very careful with is our utilities offloaded, um, and does the model catch up with that? And I don't think it does. So most all the Smith properties are completely gross rents. They will pay the utilities and deliver the heat to the units. Where many renovated sites will dismantle their boiler systems and put in electric in each unit, and then separately meter the units. It stabilizes the income because if you have a cold winter, the landlord doesn't get hit with extra costs. With the Smith properties, they're all gross operations.
Okay. And then so I guess further to that, the marketing of a property through Colliers, would it be marketed with the rents at $184,000? Is that what?
No, never, not at all. No. The marketing would be done on a stabilized basis, which is uh, similar to the methodology that the city uses, but
Okay.
we would do our actual investigation. And as I said, the most common issue that we see in the stabilization, well, the three now is one is the interest rate, and then I mentioned the property tax credit, and the other one are expenses.
Okay.
Our people actually visit the sites, go through the list of what's been done, and generally, like I said, someone puts it up for sale, they're spending a bit of money to fix it up. So your last year R&M pre-sale tend to be higher, and then that gets adjusted based on the view going forward that we fixed a lot of things. And selling an apartment's like selling a used car. You don't put an ad in the paper, I got 3 flat tires and a dead battery. No, you spend the money, you fix it, and you try to get a better price for it. And that's one of the dangers of these of all these income and expense forms. Is that's why I say the city's got to go out and investigate these costs and determine, was this making it nice for the sale or not. But no, we would these properties, there's a consistency, and I'm talking back to 2008 on the R&M. There's really not much you can do with that, right? It's ongoing.
Those are all my questions. Thank you.
Thank you. Mr. Stephenson, questions?
No questions, thank you.
Thank you. Ms. Anderson, questions?
And I have no questions. Thank you.
Thank you very much, and I have no questions further. Any quick summation, gentlemen?
I have no summation. Thank you.
Mr. Neufeld?
None for me.
Thank you. Moving along.
Okay. So 1515 Pembina Highway, I
Correct.
believe. Okay, we have file number 24-4384, roll number 030-701-05100, 1515 Pembina Highway, roll number or roll year 2025, assessed value 1,390,000. Classification 20, liability taxable. We have a 2-story built in 1960 with 17 suites. And if we look here, we can see the location being where it is on Pembina Highway, a little bit closer towards Chevrier, where by like across the street would be Crescent Drive Park. So another good area down that South Pembina location with the good demand for rentals being by the university. Have all the things that would make up a good multifamily location. Now, if we go to the income value summary, you could see that we are coming in at 767.82 per unit, and that works out to 165,849 on the gross rents, and then the expense ratio 56.77, get our net operating income of 69,474. Cap rate of 5%, getting the market value 1.390 million, and this is coming in at just over 77,000 per unit. Now, when we look at the average monthly rents per unit based on other similar type properties on Pembina Highway, you could see that we're well below here what the other properties have been reporting and that are on the same street, same year built. So again, from an income side of things, I think we're totally reasonable. And if we go to page 8, so you could see again, this is another Smith managed property to the similar portfolio like we've just discussed, where the rents they're stating gross are 207,012. They're getting 163,080. Repair and maintenance, 93. I believe it's like 93,000, which would be quite high per unit. You're looking at well over 4,000 per unit, and so I guess I would have to say, like, is there something actually going on for renovation? Because we're now getting into the territory at that rate that, like, what are they doing, in terms of investing that much into the property at that rate for only 17 units. It just doesn't seem to add up in terms of that type of ratio. But I think overall, when we look at the end number though at 1,390,000 and the market value per suites at 77,200, I would think that our valuation on this one is perfectly acceptable, and that would conclude my presentation. Thank you.
Thank you very much. Questions, Mr. Newfeld?
Well, you made some comments about repair and maintenance. Are you presenting the board with any facts?
Only the fact of what they've put on their income and expense mailer.
Right, but you made some speculation but you've got nothing to support that, do you?
It's very yeah, no, there's nothing to support it, which means I don't really know how we can justify adjusting the value if we're not being shown what's been done to the property, right? So
Okay, I just want to clarify, we're talking about some speculation without evidence. I just want to clarify that, and I'm not saying you're right or wrong. I just want to characterize what you've said.
you've characterized it correct.
Okay, good. And everything that has been done in the workup was page 3 is from the model then?
That's correct.
In regard to the income, did you look at the previous years? I think you may have included it here. I see you did.
Yeah, so I did include it,
Page
and
10.
yep, page 10, correct. Yep, there's a 2021 income statement that would show that the value was 31,552 per unit, and then it jumped to 93,347. So the $60,000 on a building like this in 1 year. I just out of curiosity, well, I mean, since you've brought it up to me, is there a reason for that, or is it just?
Yeah, well, you get to ask your questions later. I'm just you're answering now. Okay, but my question was, did you look at the previous year? Wouldn't you have put a little more weight then on the previous year?
I would probably, if I was looking at it, have done a similar way where I would have used the 1,500 per unit price, which I think if that were to happen, our NOI would be more than reasonable at the 1,500 per unit, which again, I know you were saying was speculatory, but that's what I would have done.
Okay. Sorry, I accidentally closed yours again. I have to get back to it. But that particular NOI on the previous year is still well below what the model put on, is it not?
The previous year, well, that is correct. The NOI is lower, but the income's also significantly lower. So, you would probably use the most recent income, would you not? And then use the
That's a style point there, but I'm just asking, hard numbers.
okay.
Previous year, 2021, 52,000. And as I've stated, and I don't think there's a disagreement, is that expenses are a mix of fixed and variable. Wouldn't this have given you a little bit of thought that it's still significantly higher than what the model generated?
Yeah, I think the model's pretty accurate. So,
Okay. But no, did anyone go to the trouble of asking the ownership or ourselves, the agents, except for when you're going to ask later today, why there was a difference?
no.
Okay, those are my questions. Thanks.
Thank you very much. Ms. Anderson, questions?
I have no questions, thanks.
Mr. Stevenson, questions?
No questions at this time, thank you.
Thank you, and I have no questions. Mr. Neufeld.
Thank you. So I always have been noting more and more the differences in the revenue stream, and these are not for a reason that of any sort of rehab program. This is natural, what the market's indicating, and you can see that from 2020 to 2021, there's a very large decline, followed by a recovery in 2022. This was, as I was speaking earlier, this type of property hit a significant decline, and unfortunately, their increase was due to refugee situations from Ukraine and Syria, which helped the income and brought it back to the previous levels. Looking at 2020 to 2022, you'll note that the income only increased by $2,000, which is 1.2%. One of those years had a 0% guideline increase. One had a 1% guideline increase. So natural growth, as tempered by RTB, is the reason for it. But what gave us a little bit of concern was dealing with the off years. We made the decision in this case, all three of the buildings for the same owner, we treated differently on a one-on-one basis. We found out what the issues were and determined what we were going to apply. We determined that we would use the final year of income because the 21 was off, but it recovered, whereas the previous one was in constant decline. So we used 165, and the expense side. So if you'll note on page 4, no, that's the old one. Never mind. Page 3. Their last statement showing 159,000 in expenses. We made an adjustment there, and that adjustment was approximately $60,000. But the math on it is really, really simple. We looked at the 21 R&M at 31,000 and substituted that for the 22 R&M at 93,000 to stabilize. We didn't use the 93,000 at all. So that's why the expenses aren't listed at 159,918. We've put in stabilized amount at 98,093. And we did this because we found out what it was for. And it's actually kind of obvious that you don't even need to ask the owner what it is. You go to Google Earth and look at the satellite picture, and you'll see, oh, all of a sudden, 2022, there's a new roof. But so we did not expense that. We took that out. And there are then stabilized NOI, which is using an average of the stabilized expenses, and the last year of income is 61,041. As before, this company bought 2 properties at 6%. They determined the market, and so I am just going to change that to 6%. 61,041 at 6% is 1,171,750, rounded to 1,017,000 on this. And I checked the old assessment is a typo up there. I don't know what that was, a copy from another one. It wasn't that amount. But and that's really the short of it. It's same concept in terms of cap rates. We got a small unit size, which drives the expense ratio up and reflects in a greater risk in the cap size. But you'll note that the ones they purchased in our cap rate analysis were smaller units as well. So this they know their business. They want it. They need a 6%, and to make their system work, to make their management style work, and it's geared towards these properties. There's nothing new other than that, and I will have a summation.
Thank you. Questions, Mr. Mickelson?
I think my questions basically can carry forward from the other one we had spoke of. So
Thank you. Mr. Stephenson, questions?
No questions, thank you.
Ms. Anderson, questions?
I have no questions. Thank you.
Thank you, and I have no further questions. Quick summation on this, gentlemen.
I'm okay, thank you.
Mr. Neufeld, a quick summation?
Yes, I presented a number of issues that this market is going through, and again, it's back to the same issue. We see the world, the assessment world value in 2-year segments. It's not a continuation. Prices go up and down. I think there's a reluctance for anyone to admit that we've had drops in value, but we have, and it's been driven by the factors I've been bringing forward. The major one being the interest rate. The entire real estate world is not driven on hypothetical value, hypothetical decisions. It's based on money. It's really, really simple. You gotta take a loan out to pay for the price. You gotta make enough money on it to pay your loan, and you have to justify it on that basis, and that's why there's a cap rate. I don't think there's a single person amongst us who doesn't, when they buy a house or something or a car, don't figure out what the loan is going to be to see if I can afford it. If I can't afford it, I'd have to buy a cheaper one that I can afford. It's the same idea. We have to live with it in terms of the interest rate. And anecdotally, I'm going through. I'm looking for a new lease on a vehicle, and my new lease is going to be $300 higher than the old one. It's all interest rate, and that's where the impact is felt. So it did hit the multifamily world. When we are discussing the other factors, there it's the concept of actual versus model-driven numbers. Well, nobody makes a market decision based on a model. They make it based on due diligence, and the city's model has the same issues with reliability and accuracy as any model the formula's real simple. We learned it in high school. You know, it's accurate 19 out of 21 times if there's an adequate sample size. And this is not an adequate sample size, and you have to look at the outliers and figure out if they belong or they don't. That's the problem with the model. And so the actuals always rule in terms of what's an actual deal, because we're charged with looking at market value. The Act doesn't say what did the model say. The Act says what did the market say, and the market says this is what these properties earned. This is what they buy for. And my last point on this is what I've said 3 times already. The authority in a cap rate is not the assessment department. It is not an appraiser like me. And it's not even a broker. It's the people who do the transactions. I've given you 2 examples of purchases made by this particular owner. In and around the reference here, the target was 6% on their acquisitions. They've been doing this since 1912. I put forward that they are the authority on cap rates, not the rest of us. And they are telling you it's 6% on properties like this. Thank you for your patience, and apologies for the multiple time for totally my fault. I thought I was supposed to be in at 5 o'clock, and I had arranged a dog sitter and everything. So I guess I don't need that dog sitter anymore.
Mr. Neufeld, we have one last property.
Oh no.
And I was just wondering why you have not put in a brief on this particular property. Is there a reason?
What's the address?
1520 Pembina Highway.
1520.
Correct. What's going on, but you do not have a brief here for that.
Just let me just check one thing here. I thought I was finished.
I would have loved to say that you were finished, but
yeah. 15. I'm going into our, you know, we have had one problem with the server at the city not accepting file sizes. So 15.
Sometimes they have to be set separately, and I appreciate
right.
Yeah, that might be the case, but you should have been notified by your system that that particular one may not have made it through.
Right. I believe we did the city provide a brief? I take it?
It did, sir.
What's the file number?
Go ahead, Mr. Michalak, please.
That would be file number 24-4253.
42. Okay, so I don't have that at all, and that would be because they're saying we didn't submit. Okay.
So is it possible that we could just have the number that has been assessed and just confirm for the moment, or what would you like to do, sir?
This will take me about 2 or 3 minutes just to look up here, just to understand what went, I can figure out what went wrong. I have the workup in front of me. I'm now looking to see about the delivery of it, and I may need a minute or 2. I'm wondering if the clerk would be able to email me a copy of the city's brief.
Sure, yeah.
Okay, and I'm just going to run away and go down the hall to the person who submitted it.
Yeah, Mr. Neufeld, maybe this would be a good point to take a 5-minute recess, so maybe you can get your file straightened away and files that can be sent.
Okay.
So quick break for everyone, and that might be warranted right now. Thank you.
All right.
Thank you very much. Mr. Michalak, 1520 Pembina Highway, please.
Yes. Okay, we have file number 24-4253, roll number 030-802-92100, address 1520 Pembina, roll year 2025, assessed value 1,437,000, classification 20, liability is taxable. We have a 3-story apartment built in 1960 with 15 suites. They're located right beside or right across the street from the prior property that we were speaking with, and it's owned by the same company. You could see we're coming in at 976 per unit, and that brings us to 970 or 175,779 gross rents, and these are all 2-bedroom units. And so expense ratio 57.81 for net operating income of 71,862, cap rate at 5% with a estimated market value of 1,437,000, and coming in at just shy of 96,000 per unit. When we look at the rental comparables, you could see that this property would fall in line with other properties in the neighborhood again. So we got a range from 962 up to 1091. So we feel good from an income side of things on the property. Now, when we look at this building again, similar one to the ones we've just spoken of, built in that same time frame. On page 8. So page 9 though would just show their income statement here. That would show. Oh, is this? So it does say on here the income ending 12/31/2023, but this was an income statement for us that was sent in 2022. With a due date of May 2023, which is the 2022 mailers. So I don't know if that was accidentally filled in wrong by the applicant, because it was signed as May 2nd, 2023, and they're putting an end date of December 2023 on the statement. So I'll say that this was supposed to be for 2022 income on page 9. Now, when you look at it, the repair and maintenance is 108,994, and they're showing a negative net income. So, based on that, it's only 15 units. I assume there's been some type of work done to this building that maybe that R&M has a lot of capital involved. If you look at their 2022 income or 2021 income statement, sorry. You could see that repair and maintenance is like 4,000 a unit. So again, we're still getting quite high on that regard. Now, if we do kind of look at R&M that's been used at the $1,500 per unit amount that I had been using on the prior ones, their net operating income would be more in line with what the model's presenting. We'd be quite close. So again, I'm gonna go with that in terms of the NOI being at 71,862. And yeah, that would conclude my presentation on this one. Thank you.
Thank you. Mr. Neufeld, questions?
Yes. You did provide an aerial view, I take it, or am I missing it?
I didn't provide an aerial view, no.
Okay, so you didn't notice anything unusual about the parking situation?
No, I shows we have 16 outdoor parking on our record, so I didn't notice anything unusual.
Okay. And this was all the model generated here?
That's correct.
Okay. There was did you note the decline in revenue on the statements provided? Sorry, I'm just trying to read something here.
Yeah.
Oh, maybe there isn't. 1031 22. Yeah, I'm looking at the statements.
There's a few thousand difference from 2021 to 2022, which I presume is 2022. There was a error that they probably filled out 2023 on it.
Yeah, which one was that? What page was that on?
On page 9, they wrote in 12/31/2023, but I'm based on what they signed for, it shows May 2nd, 2023. So
Page,
I'll assume that that was an error on their part in
page,
the date.
oh, sorry, I was looking at the wrong one here. Page 9. Yeah, so 23, but that's likely the 22.
Yeah.
Yes, that's what I have as well. That
Okay.
it was a 22 statement. So
Yeah.
that 22 statement, and then the one before in 21 statement, there was actually they indicated a decline in income, correct?
Yeah, that's correct.
Okay, no more questions.
Thank you very much. Ms. Anderson, questions?
I have no questions, thank you.
Mr. Stephenson, questions?
No questions, thank you.
Thank you both. And I have no questions. Mr. Neufeld, would you like to verbally give us your valuation on this property?
Yeah, this one I really would have been nice to show you the picture. The property is comprised of two sites. One is 1520 Pembina, and the other is 1 Finch Street, Finch Bay, I should say. And Finch Bay is a bit of a cul-de-sac that runs off Pembina Highway between these two apartments and the post office. And it was there's a lot line on it, but the parking for most of the parking is on Finch Bay, street parking, not the property itself. And well, I can't show you the picture. So the income we used, I can refer to the assessor's workup, is on his page 9, which is the 22 statement. We're using the same number, but we're actually applying expenses of 107,362. So we're reducing it from their stated amount of its maintenance and repair downwards by the total. Like I said, they had was 186,356, and we were using 307,362, which is 2,000 a door. What we had, again, this is the same issue as the other one. We knew what both of the work done was in both 22 and 20. One was a roof, and the other was repaving. So we adjusted those out because they are long-term costs. And everybody's treatment under the tax system is different. On a short-lived expense like this, there's different methods of depreciation, but they haven't split it up. They run one journal for all their costs. But it's quite apparent. So on the 21, we've reduced the expenses by from they were 132,667. We reduced them to 101,939, and that was all to do with R&M. Now in our workup, we had an additional row for 2020 expenses, and we reduced them subsequently. So when we worked it all out, our stabilized expenses were 103,788 on a 3-year average, which is a 64% expense ratio, very consistent with this operator's other buildings. This one stuck out as being, and of course we knew what the required adjustments were. This one though is in significant decline, not just the previous 3 years, but going back further. So we ended up using the 2022 year for income because there's no, it doesn't appear like there's any abatement in it. So that number is 160,176 with our stabilized expenses at 103,788. Our NOI is 56,388, 56,388. And again, since I've said it, I gave you a preview of the summation, so I don't have to do it again. 6%. So 56388 at 6% is 939,800, rounded to 940. This is a decrease from the previous year, but so is the income. You know, I don't have to go back and summarize this again, but you know, this is just another indication where income declines. The legislation says you do it in market value. We've accepted that it's the income. You can't make income go up because you don't believe that the market has declined, but it did. Those are the numbers we should have submitted, and we take blame for not doing it ourselves. The error was at our end.
Thank you, sir. Appreciate your candor on that. Mr. Michalak, do you have questions for Mr. Neufeld?
Yeah, so just here, like when they talk about the income, the posted rents, like I guess the gross rents they wrote into us in 2021 was 221,720, and then in 2023 or 22 they went up to 238,972. So they've gone up like that's like 7 or 8% of the rents they registered at RTV. Like, is there a reason for that?
Yeah,
That it would go up that amount, but yet the income they're receiving is lower than the other year?
yeah. Well, again, it doesn't make them more money, but it's a registration. So they had the two projects, the roof and the paving. So what you do when you get that is you apply for an above guideline increase.
Mm-hmm.
So RTV book changes the rent on it by greater than the permitted amount, and you can get above guideline increases for capital investment. You can get it for if your taxes went up too crazy. You can ask for an above guideline increase, and so that's what they're registered at.
Okay.
But not what they're getting.
So would that be the potential a purchaser would be able to realize that?
No,
Take over the property, or would someone have to move out for them to realize higher rents? Is that
no, you could do it at an end of a lease term legally.
okay?
You could
Okay.
do it at the end of a lease term. But the
Okay.
point is, you know, do you want a vacancy, or do you want to accept the rent the market dictates?
So there's no rent roll though provided through them that would show what the rents are that they're charging per year.
Well, you know, the difficulties with the rent roll is that these are residential users, and so that belongs to that's a whole privacy debate on that identification of people's personal things. And
Okay.
even I can't have it. Like, I have to get written permission from every single occupant to get any personal details. We just don't do it.
You can black it out though, as has been done in the
Well,
past.
it'll still spell the unit. And I
Okay.
suppose it's a bit of work. We might be able to, but
Yeah.
there's no mystery here.
Wow. Okay. Okay, no, fair. Thank you very much. Those are all my questions. Thank you.
Thank you. Ms. Anderson, questions?
I have no questions, thank you.
Thank you. Mr. Stevens, questions?
No questions, thank you.
Thank you very much, both. And I have no further questions. Gentlemen, I believe now we are complete. Unless
Okay.
there's summation, but I don't think so, correct?
Just like for me, very brief, just summation on the whole docket is on, I know I had touched on how we come up with our cap rates. how we approach stabilizing those cap rates that I've been presented today, and so that's how our values are determined. And I think on a price per unit basis as well, I think as a secondary check of value, I would say that our price per unit is more than reasonable on these properties relative to cap rate sales that have been presented by us and the applicant. So that would be all I have for summation. Thank you.
Thank you very much. Mr. Neufeld.
Yeah, I think I said it already.
I think you have, sir. If I'd be so bold to say, I think you've already went over this at least a few times, so.
Yeah. Well, sometimes people don't listen the first time. I don't. I'm
Mr.
thankful.
Neufeld, you're suggesting we're not listening? Come on.
No. As a matter of fact, you've been great with me. I messed up this morning, and we messed up in the afternoon, and you've been very patient with me. You could have chastised me. Not that I would have listened, but you know, it's a good
atmosphere, right?
It's a good atmosphere.
We're trying our best. Thank you very much for your time and patience, both. And this would conclude all the scheduled items for this hearing. And so I'm now going to adjourn the hearing. Thank you very much again.
All right. Have a good day, everyone.
All right.
Thank you.
Have a good day.